Hello everyone, this is Equity Management Academy, with our exclusive weekend webinar. The conflict in Ukraine is straining the global food supply. Food prices are soaring. Global food prices are up more than 20% since 12 months ago. We are just coming out of the pandemic, which significantly affected prices. Now the war in Ukraine is pushing up prices. The UN warned that we may be looking at a global food crisis not seen since World War II. The total caloric value of food exports from Russia and Ukraine are about 12% of the world's caloric intake. If Ukraine can't plant now in the midst of a war, they will have far less to harvest at the end of the growing season. Russia and Ukraine are huge agricultural producers. In 2021, Russia exported $37.3 billion of agricultural products. Ukraine exported more than $27 billion. They are a breadbasket of the world for corn, about 25% of exports in the world, and sunflower oil, 74% of world exports. Ukraine has banned exports of several grains, sugar, meat, and other food. In March, Ukrainian food exports fell 4 times less compared to February. The Ukrainian access to seaports is also threatened or cut off by the Russian invasion. In the midst of war, Ukraine is facing diesel shortages, and since most men are in the military now, there are far fewer people to plant and harvest. Fertilizer prices are also rising quickly. Ammonia, nitrogen, nitrates, phosphates, potash, and sulfates are up about 30% since the start of 2022. Russia and Belarus are big exporters of fertilizers, and with sanctions against Russia, those exports have dropped sharply. Natural gas prices are also much higher, and it is used as a feedstock for nitrogen-based fertilizers. If we produce less fertilizer, then less is used and yields are less, which could affect global food supplies. Global warming and supply chain issues had made global food supplies tight even before the war in Ukraine. North America had a drought that affected the wheat crop. Soybeans in Brazil were hurt by a drought too. Food prices are at the highest level in 2 years. The U.S. Department of Agriculture predicts a 4% increase in food prices this year. The war in Ukraine will only further increase food prices. The U.S. is a net exporter of many foodstuffs, but food prices rise globally and will affect U.S. prices in stores. Consumers will see it. A food shortage is unlikely to occur in the U.S., which imports very little, if any, food from Ukraine or Russia. We will see price increases, but not shortages. Shortages and rising prices will harm some countries and marginalized communities. A global food crisis could lead to further conflicts around the world. The Arab Spring was, in part, triggered by rising food prices. The Middle East imports much of its wheat from Ukraine and Russia, a supply which is now threatened. Some countries are banning exports of food products, such as Hungary and Serbia. It is a short-term solution by keeping prices lower in that country, but globally it just pushes prices up. Such moves also tend to spread, which can lead to a massive decrease in trade, and the global food supply will be further impaired. Other countries could produce and export more food. As prices rise, the incentives to produce more increase. The European Union is going to try to release some of their set-aside acres for production this summer. The US is considering doing the same with conservation acres. The US could also look at biofuel policies. About 40% of soybean oils in the US go into biodiesel, which becomes questionable when food is scarce and prices are soaring.
Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk for Monday, April 25th, 2022. I wanted to share that report with you, as I feel the media is not covering the issue enough. And I wanted to take a look at the reports also that we published over the weekend regarding gold, silver, Bitcoin, and how we're using standard deviation to identify basically the entry points, the trigger points using the variable changing price momentum indicator. I want to take a look at the report that we published in Seeking Alpha here over the weekend. Besides this special report on food shortage, I want to take a look at the weekly standard deviation for the gold market. As of April 24, the weekly trend momentum of 1947 was bearish. The weekly trend momentum is the bigger trend in the market. It's the overall trend in the market. When it trades below the trend momentum price, basically it changes the trend from bullish to bearish or to neutral. The weekly VCPMI, or the variable changing price momentum indicator, is the standard deviation, 50-50 standard deviation level, or the mean. And we use this level to identify the extreme of that standard deviation, or the extreme above or the extreme below the mean. And we're looking at mathematical probabilities. And so what I do here, in what I'm teaching to my subscribers in my private trading room here, is basically to use these levels to identify trigger points for day traders, for swing traders, or for position traders in order to enter into the market intelligently using the fundamentals that we just talked about. And so what it means basically is that those fundamentals indicate that we are going to be looking at a potential shortage of food, potential famine around the world, and it's going to exacerbate the cost of food, basic food, unless we see a resolution in the Ukraine-Russian war, and we begin to open up exports immediately. There is going to be a potential squeeze, a short squeeze on commodities, as we saw it in nickel here recently, and we're beginning to see in other metals. And even though the market in the futures markets sometimes is contrary to the fundamentals, the reality is that this area plays a major part in supplying commodities, wheat, corn, soybeans, metals, palladium, gold, silver. And so what we are seeing here is, again, a potential squeeze in commodity prices. On top of what we're looking at is a highly inflationary level that is being, once again, exacerbated by the economics that we have, such as basically wage price inflation as a consequence of the uh, pandemic that we saw back in 2020, this economy has been completely distorted, upside down. We're looking at a $30 trillion in debt. Interest rates are going up rather rapidly without the feds having to do anything. And so there are, I believe, a lot of elements that are out there that indicate the possibility that we're going to see some kind of volatility here over the next few months, and particularly with prices of inflation, with the cost of food, and basically the pressure for the feds to want to do something about interest rates. Coming back here to the algorithm, and we use standard deviation to identify basically the levels above or below. So once the standard deviation is identified, and for example, we have a bearish trend, then a close above 1973, which is the 50-50 standard deviation, would negate this bearishness neutral. So if I want to get on the long side and I want to take advantage or trade from the long side, this gives you a very clear picture in terms of what the trigger points would be in shifting the market from bearish to neutral to bullish. It also tells you here that because the standard deviation signal is bearish, by trading below 1973, we have the target. So, we got two signals basically. That gives you a stop. If it closes above 1973, it's going to negate this bearishness to neutral. So the weekly variable changing price momentum indicator is way above. It's at 1973. The trend momentum is 1947, and the VCPMI is the price momentum within that bigger trend, which is bearish. So we have both bearish. We have the trend momentum bearish, and we have the price momentum bearish. But it does tell you that if we close above 1973, number one, it would negate this bearishness to neutral. And if you're short, to take profits at 1862 to 1873, 1862 to 1873. So the low that we saw today so far is 1891.80. So we're stabbing potentially into this area that identifies the extreme below the standard deviation. The two standard deviation weekly buy trigger is 1862. Now, in looking at the numbers weekly, what we do is we integrate also the daily numbers as the market rolls over from the daily to the weekly to the monthly to the yearly to the cycles. And so what we see here coming in today, we have buy one level 1921, buy two level 1910. And right below that, we see 1862. Now, as you notice here, the color is in blue once again, and the algorithm now, besides identifying the extreme levels of standard deviation by using pivot points, identifies the highest mathematical probability where we can potentially see buyers accumulate supply, come into the market and buy all this selling pressure or supply that was activated by the market trading below the daily mean of 1939. Not only the weekly, 1973 was bearish, but we also activated the daily. And so we integrate the signals, the weekly and the daily signals. And what we're seeing here is basically that the gold market is extremely oversold, and it's either going to come down to 1862 and activate a weekly trigger, or if we get back above 1910, it's going to activate a daily trigger and engages basically the long side of the market on a daily basis, and the levels above are 1910 to 1921, all the way up to 1939. So we're waiting for a trigger point in gold to day trade the market, either on a close above 1910 using the 15-minute bar or a test of 1862. It's very clear. Focusing on silver here, we had a signal activated earlier here at about 23.54, activating a weekly buy trigger and completed the target of 23.68. One of the things that I do and I want to share with you is basically that we use the trading floor to execute all of the signals, and I make a point basically of documenting every trade that we do, that we execute live in the trading room for the benefit of my self-directed traders, my individual traders that use this information to trade their own account based on their profile. But I do make a point, whether I take a loss or a profit, to document every trade that we do here in our trading floor. These are the markets that I am using to trade and capitalize out of the crisis situation that is unfolding, that potentially could lead again into some really massive moves in grains, even though we have seen the wheat market trade 1135 not too long ago. Here it appears that the high was made 1363.50, and what we saw here was this spike that was as a consequence of the war in Ukraine. This was the initial response. This was the initial thrust, and it's actually the first leg or the first wave of five waves or five legs, you might say, that appear to be unfolding. This was the first one. The second one here was completed. We're unfolding into the third of this move. And the third leg equals basically double the first leg. So it could be a phenomenal move just on the third leg that could point to about $16 a bushel. And this also corresponds with the Fibonacci extension 161.8%, 16, 13, 19. The 261.8% extension, Fibonacci extension, is all the way up to $20 potentially for wheat to trade. These are the numbers that we're looking at. So the potential is explosive if we do run into transportation problems from the Black Sea. Soybeans traded 17.59, and we seem to be consolidating after making these highs here recently. Corn made a high of 18.19, and it looks like the trend obviously is up, way up, for commodities and grains and so on. Now, we're focusing on using basically wheat, which is the Teucrium ETF for wheat that you can buy and hold without the futures contract margin requirements. And it basically follows the movement in the futures contract. And you can see here we saw a phenomenal move from about 750 to about 1275 here as we made a high of $13. We've come down pretty much following the same pattern, and we're unfolding the third leg here, which seems to be building here. So I believe that these instruments are giving us the opportunity to take advantage of this food crisis situation that's unfolding and continue to trade the metals, gold, silver, and Bitcoin, as basically the instruments that are being affected by inflation, that are being affected by the implosion of the US dollar as the reserve currency, as we unfold basically this inflationary factor here that is daily diminishing the intrinsic value, the purchasing power of the US dollar. I wanted to make a couple of comments here. We have news coming out of China regarding the lockdown that seems to be a pretty serious situation unfolding. And they're taking some drastic measures, basically, even in locking people in their own homes to prevent widespread, as we did back in 2020. So the question is this going to spread to the United States or to Europe and cause another panic regarding COVID? The Chinese market is falling roughly down about 5%, the weakest level since November 2020, right? Very reminiscent. And there is a run for food in anticipation of more additional lockdowns. So this situation, I believe, is something that we need to pay attention to, as it could affect, again, the supply situation coming out of that region. People are not going into the fields, they're not working. Again, we're very similar to what we saw back in 2020. But I'm not saying that it is the same here in the United States, although it is something that we do need to pay attention to, and the markets potentially are going to react to this, or might be in the process of incorporating or discounting, you might say, this information. We're going to continue to trade from the long side on these instruments here, as I feel that the upside has a lot more potential here, even though we've seen a little bit of a correction unfolding here. We're prepared to add to our position into these levels here that indicate, once again, the market is in an area of support, in an area where it is telling us to accumulate, and accumulate according to your profile, accumulate according to your risk tolerance. Don't overtrade, don't overmargin. But I do believe that every time we come down here, it's time to add to your position. Not too long ago, we were looking at 1750, 1800, and we were thinking the same thing, talking about the same thing, and so far we saw a high of 2078, and I think pretty soon we might be hitting, as we unfold this trough, as we unfold this bottom that it's building here into August, September, we could be looking at about 2100 to 2200 for the gold market. Until next time, my friends, please have a great week. Be safe. And we'll talk to you soon. Take care.